Welcome back, everyone. Today on the Joseph Carlson Show, during this time period of the past couple of weeks of uncertainty and chaos, of tariffs and trade wars, I've been buying stocks. That's primarily what I've been doing. Aside from doing commentary and giving some thoughts on currently what's going on, the primary action I have taken is to buy more into different high-quality companies. Now, some of these companies you know about, companies like Google and Amazon, which we'll be discussing as well. But there's one company new to my portfolio that I haven't talked about as much. And this company is a new company that I decided to buy into amongst all this chaos at a depressed share price. The company is called Equifax, and I've put over $20,000 into this stock. Now, in today's episode, I want to go over my simple investment thesis of this company. The reason that I believe it has asymmetric risk, meaning low downside risk and very high upside. This is a company that I think is not understood by the market fully, and one that may be worth looking at. So we're going to be going over it in this episode. I'll be giving a summary of my Equifax bull case, and we also have some other news to get into as well. We have an interview with Jassy, the CEO of Amazon, on his thoughts on all this stuff going on. How does it impact Amazon's business? What is he seeing with the tariffs and the data in Amazon, retail behavior? And how does he view this in the future? Amazon, after all, is a company that employs thousands of data specialists and economists. It's one of the most well-connected companies with the global economy. So it's interesting to see his perspective. And we'll be looking at this interview, his thoughts on investment, consumer behavior, and Amazon's future plans. We also have news of the continued fallout of the tariffs. One of the biggest arguments early on was with the stock market dropping, it's not a big deal. It only affects rich people. And after all, wealth inequality is a problem. So if this hurts rich people and helps poor people, isn't that a good thing? Not really. In this case, the tariffs actually have the biggest impact on small businesses. And we'll be going over the reasons why. And then, of course, we have more news on the tariffs. For example, we have China now trying to come up with creative ways to hurt the United States. One of them is limiting Hollywood films that are able to be shown in China. Now, we'll start things off with the new buy. The company that I've been pouring money into because I believe it's at an attractive valuation and it's a very high quality company that has some very unique bull case. The company's called Equifax, ticker symbol EFX. It is the credit bureau, one of the big three, and most people know it as a credit bureau. Now, if we look at the passive income portfolio here, we can take a look at it, and I have it in the financial category. I now own $22,000 of it, currently $1,000 in the red. In most cases, the companies that I buy into in the short term, they will immediately go into the red, and that's partly by design. I buy stocks as they're going down, not as they go up. If I bought stocks when they had upward momentum, they'd immediately go into the green. But in most cases, I believe I can get better deals right now where investors are very spooked, very concerned about what's going on. These are the times I like to buy. Equifax can be broken down into two main parts. The first and biggest, which most people know it for, is the credit bureau. That's where you go to get a mortgage from your bank and they run your credit report. Now, that report is your credit history. It tells you whether or not you paid off your credit cards, whether or not you have any outstanding loans, just your credit score. Now, they wrap this into a service called Mortgage Solutions where they productize it. They allow the data to be sold to companies like FICO that wrap it into further analysis and different credit scores, and it works in that entire solution. They also have some different marketing services based off of this as well. But overall, this makes up just over 50% of their business. Then we have the other 43% of Equifax's business, a big chunk of it, which is growing much faster and is a much better portion of the business. It is the identification business. It's called the work number. That's the name of the product. Most of you probably aren't familiar with this aspect of their business. Now, the work number is a product to basically say, I know who I'm dealing with. For example, if you're loaning a big amount of money to someone, you may want to verify that they actually have employment, that they can actually pay you back that loan. Now, you can try to call up their current employer and ask them that way, but that's not always the most reliable or efficient way to confirm someone's income when you're trying to give them a loan. So the work number does this for you. They work with trusted partners, which can verify this information and provide it to different parties for lending. It's also not just for lending, it's for hiring. Lots of companies require that they know the history, income, previous work, schooling, and who they're hiring. And they don't have the time to go through and verify all this information. Equifax has developed this product, created the entire network of trusted people to be able to offer this information in a very efficient way. So you can see how valuable this can become, especially in a time where hiring fraud is becoming more and more common. People tend to lie about their employment, their work history, what they've done in the past. There's lots of people that will fib about their history or outright lie to try to get jobs that they're not qualified for. And this can be especially concerning in government jobs or jobs that are more high stake that require professional training in certain instances. So this can be incredibly important to some companies. And again, this business that Equifax has developed is growing much faster. So overall, the type of services and businesses that Equifax is in are the very type of businesses I like to invest in. They're digital based, they're very scalable, they're high margin, they're replicable, meaning that you can scale this business to the entire world. The total addressable market is gigantic, and they continue to grow organically without much marketing. This is the very type of business qualitatively that I look for. But that's not the only reason that I bought Equifax. There's more to it than just that, because I found a number of companies that sell great products. On top of Equifax offering these high quality products and services that have high margins and they're moaty and they have a lot of growth, I also believe that this company is under earning. Saying a company is under earning means that the company is not earning as much as it normally would under normal circumstances. There's specific things happening right now that are temporary in nature, causing the company to earn less money. Whereas if I said a company's over earning, that means that right now there's specific reasons that are causing this company to earn excess money that are eventually going to go away. For example, I could say that Netflix over-earned during the COVID dip. They gained like 20 million subscribers in a month. That's like a year's worth of subscribers in a single month. Obviously, they're kind of over-earning during that time period. Wasn't going to last. Growth was going to slow. Well, the same type of thing can happen, but the other direction. There's different circumstances that can cause companies to earn far less money than they would under normal circumstances. And I believe that's what's going on with Equifax. If we look at Equifax, this company is facing a series of headwinds that are incredibly intense. If we look at Qualtrim, for example, and the risks of this company, it summarizes them very succinctly here. Right now, we have weak mortgage demand. The company is facing significant pressure from the US mortgage market, with expectations of a 12% decline in mortgage revenue credit inquiries for 2025. So right now, with the current valuation and the current expectations of Equifax, we're factoring in a 12% decline in mortgage volume. Then you have the other half of their business. Remember, they're not just a credit bureau that's offering mortgage services, they also have identification services that are mostly active when businesses are hiring aggressively. Weaker hiring trends. There is an anticipated decline in US hiring of around 8% relative to 2024, which further impacts the company's talent verification and onboarding revenue streams. So on one end, we have a weak mortgage market, which negatively impacts their credit bureau and mortgage service business. And then on the other, we have the weak hiring trends, which negatively impacts their identification services. This is factored into this year's guidance. Then we have a third one, currency fluctuations. A strengthening US dollar is likely to negatively impact revenue growth by around 130 basis points. This is exactly what was put into their guidance. With currency fluctuation, we have another temporary headwind for this business that won't be around forever. And then we get to yet another headwind. The anticipated increase in depreciation and amortization by about $55 million in 2025 may constrain profit margins and adjusted earnings per share growth, posing additional financial risk for the company. And then that's not the only headwinds this company's facing currently. They've also been going through this massive cloud transition. We know that a number of years ago, back in 2017, Equifax had this massive breach. All of this credit information was stolen from their databases. It was one of the worst breaches that we've known of any tech company. It was terrible. The CEO was fired, and the company had to completely redo their entire tech architecture. At the time, they had data siloed across 62 different servers. Now they've spent the time to move their data to Google Cloud. Equifax has completed a significant transformation to a cloud-native environment, now having approximately 85% of its revenue in the new cloud. Now that they're done doing that, they're not going to have to pay for those transitional costs anymore. All of those one-time burdensome costs are behind them. Their margins are going to go up as a result of getting this massive expense behind them. Now they're focused on the future. And not only are they saving on transitional expensive costs, but they can deploy different products much faster in the future. For example, during this time period, they've been developing data and analytic capabilities. The company's advancements in AI and machine learning, particularly through the EFX AI platform, enables the development of innovative products and services that utilize the work number indicators, enhancing its competitive edge in the market. So overall, my thesis in Equifax is very simple. I believe that the company is appropriately priced, even with all these headwinds currently impacting it. In fact, right now today, with the impact of currency fluctuation, changes in depreciation and amortization, the impacts of the mortgage market declining, hiring declining, and so on and so forth, the company trades at a 26 PE. But if these things improve at all, which they eventually will, Equifax will earn far in excess of what the analysts are expecting, and they'll be forced to increase their analyst estimates. And for the long-term investor that can buy during distressed times, times where it looks like the company's doing poorly, I believe those investors will be rewarded once these factors start to eventually normalize. Now, I'm buying into it with my money. You don't have to follow me into this purchase. I'm not trying to sell you Equifax. I'm just explaining the reasons that I'm buying into it. Now let's go ahead and move on to some news. Now we first start off with an interview from Andy Jassy. And of course, he's asked about the current events, the biggest of which obviously is the tariffs.
Well, what I would tell you is whenever you have any threat of any kind of discontinuity, as a team, you have to think about what are the things you can do to help customers. And so we're doing everything we can to try and keep prices the way they've been for customers, as low as possible. And you know, so we'll do things like we've done some strategic forward inventory buys to be able to get as many items as makes sense for customers at lower prices. You know, and there are some cases where we have deals we were negotiated that weren't done, where we'll renegotiate terms to make it easier for customers to have lower prices. So we're going to do everything we can to keep prices as low as possible.
He mentions two examples, and these are also things that Apple has done. They brought in inventory ahead of these tariffs. So as soon as they caught wind that there's going to be potentially 120, 140% tariffs or whatever it is right now, they're like, bring the stuff in today, ship it over right now, rush. You know, we want expedited shipping right now to get ahead of this. And that's what Apple did as well. Apple reportedly flew in something like 5 airplanes full of iPhones ahead of the tariff news. And it looks like Amazon did some of the same things. They brought in stuff ahead of the tariffs. The other thing he mentions is deals. If you have not signed a deal right now, but you're in the process of negotiating one, the terms of your deal is going to change dramatically based on this most recent news. Now, he's also asked if customers are exhibiting the same behavior. Are the customers buying stuff ahead of schedule? Like they're just rushing to Amazon to buy all these goods that they need so that they don't have to pay higher prices after the tariffs. Now, to my surprise, he says there might be a tiny bit of that, but not much. There's not much data.
It's such little data at this point since, you know, the first set of tariffs came out and then yesterday there was a pause. But we have seen, we see people have not stopped buying, and in certain categories we do see a little bit of people buying ahead. But it's hard to know if it's just an anomaly in the data because it's just a few days and how long it's going to last. But, you know, we're going to do, as I said, everything we possibly can to keep prices low for customers.
Now, the next one is a big question, a very important question. Who eats the cost of the tariff? Does Andy Jassy say, oh, the Chinese are going to pay for it? They're the ones paying for the tariffs. It's just money from the Chinese to the US. No, he doesn't. Of course, he says it's the customer.
Who is going to eat the cost, though? Because I think that's one of the big questions. How much can get passed on to the customer? How strong do you think the American consumer is right now? And how much of it gets eaten by Amazon? How much gets eaten effectively by potentially a third-party seller?
I think we'll have to see how it all plays out. But if you made me guess, you know, I'm guessing that that sellers will pass that cost on.
Fully.
And, you know, I think they'll try. And I understand why. I mean, depending on which country you're in, you don't have 50% extra margin that you can play with. So I think they'll try and pass the cost on. And you know, as I said, it's so early right now, but we haven't seen any change in consumer behavior in a meaningful way yet.
In this case, he is 100% correct. I really think in most cases, when you're selling on Amazon, you do not have the margins to eat any of the cost. You're going to pass all of it on to the customer. If your margins are already 3%, what are you going to do? Lower them to 2%? You don't have a lot of wiggle room there for a 50% increase in your input cost. So Andy Jassy is truthful in saying that they're just going to pass this right along to the customer. Now, there's other companies where the situation could be different. For example, I've argued for a long time period that tariffs disproportionately impact smaller businesses to a bigger extent. Larger businesses like Walmart and Costco, which have massive bulk ordering, they do so much business that they can put pressure on the Chinese seller. They can say that you're going to eat some of the cost of this tariff, or we're going to reroute our ordering to different countries or to different places. So all the third-party, individual, small-time sellers on Amazon, they don't have this bargaining power. They don't have hundreds of millions of customers like Costco does. They don't have a subscription business model. They're not going to be able to argue and negotiate with the Chinese supplier. They're going to have to eat the cost and then pass that cost along to the customer. Now, we also have questions of whether or not Amazon's changing their direction of their investments, their CapEx, their AWS investments. Is Amazon pulling back at all on some of the investments they had planned prior to this tariff debacle?
I don't see us attenuating our building data centers right now. We have very high demand.
Amazon continues to see strong demand in their AWS business. He says there's literally no change in their investment plans this year. Now, the next question is also fascinating. We had DeepSeek come out like a month ago. It feels like it was years ago, but DeepSeek came out not long ago and it was overshadowed by all the tariff news. But when DeepSeek originally came out, there was this argument that because this model's so much more efficient, it lowered all the computing costs to run it, that we don't need all this AI infrastructure. That these companies like Amazon, Google, Microsoft, and Meta are building out these server farms and AI processing plants, and we don't need them because AI is getting far more efficient to run. The market was wrong on this thesis. Andy Jassy clearly says the market was wrong, that we do need AI processing, and he's firmly in the camp that the more efficient something becomes, the more that people are going to use it, the more instances are going to find use cases for it.
No, I mean, in some ways, we would like nothing better than to make the cost of AI meaningfully less expensive for customers. The cost of AI today, because of the chips and because of the cost of inference still, even though the cost of inference has come down several times, but it's still more expensive than it should be and than it will be. And then what you need for companies to be able to deploy AI as expansively as they want. And so when DeepSeek came out with this model, which people were excited about, it felt like it cost less, it felt like the inference was less. I think if you're building frontier models like we are as well, you're all working on a lot of the same types of problems, and you're going to see all this leapfrogging. You have seen all this leapfrogging every month, and you'll continue to see that. But for me, the lower that we can make the cost of AI, the more customers are going to use it. And I think people get confused. I saw this in the beginning of AWS too, which is customers love when you take the cost per unit of something down. It allows them to save money on what they're building, but they don't actually spend less. It actually unleashes them to do a lot more innovation, and in absolute, they spend more. It's the same thing when we started AWS. We pretty significantly changed the cost of compute and storage and database. Customers loved it, but they actually spent more on infrastructure because it allowed them to build more for their customers.
When you make it more accessible, lower the cost, with technology, people are just going to consume it and use it more. They're not going to spend in net less than they did before. As I watched this interview, it solidified the conclusion that Amazon is not becoming defensive. Amazon is still building, growing, investing, expanding. They're not turtling in. They're not being defensive and concerned about near-term concerns. They're looking outwards. They're looking at how they can expand and offer more to customers. Even though Amazon is massive, one of the biggest companies in the world with a multi-trillion-dollar market cap, they continue to act immature, like a startup company, a growth company, always expanding, always offering more for customers, always looking for areas of risk and growth. So I love what Amazon continues to do. I'm going to stay firmly invested. Now, the next piece of news is we had this subject arise. When the stock market fell, 18% or whatever it fell, a lot of people were celebratory. People that didn't own much stock, or they looked at it as wealthy people getting hurt. And many people believed that you can celebrate the stock market going down because you believe somehow that money is going to be redirected to poor people or less fortunate people. This is a zero-sum game view of the world. That by harming some people's finances, you're going to gain. That the pie doesn't grow for everyone, it only is a set pie, and we all just divvy up the slices. And it's a very incorrect view of how most of economics and trading and global growth work. Now, when we look at this, I've argued for a long time period that tariffs are not a great thing for economies. They're not a great thing for growth, both on the high end and the low end. And we see further evidence of this. The Wall Street Journal has a report here that smallest businesses are the biggest losers in the global tariff war. Businesses of all sizes are struggling with President Trump's new tariff regime, but the small U.S. businesses are looking to be the biggest losers. Small and mid-sized companies account for $868 billion, or roughly 1/3 of annual U.S. imports, according to the Census Bureau. And while we are dwarfed by global giants like Apple, Nike, these businesses also rely on overseas factories of Chinese goods that still carry steep tariffs. Joe Fox has decided not to open his seasonal fireworks store in Leslie, Michigan this year. Quote, the whole decision was tariff-based. All the fireworks he sold were imported from China. Quote, we didn't want to get into something that would pass along a ton of the cost to the consumer. We are closing for the foreseeable future until this is sorted out. And this is the same dynamic I've been highlighting. Small companies like this fireworks stand has no negotiating leverage. He can't call up his supplier from China and try to muscle him down into a better deal. When you're buying small quantities of something, you have no bartering power. Trump's tariff plan has unnerved the stock and bond market and prompted some big companies to rethink productions and prices. But the sudden shift and repeated stops and starts in Trump's trade policy are roiling small businesses, which typically don't have the same leverage to negotiate with suppliers or large cash cushions. Quote, I don't think they understand that a lot of little businesses are going to go away. That's from the president of Nils Skiwear, an apparel company. His business doesn't have the cash needed to cover tariffs on orders placed in early February that are slated to arrive mid-August for ski season. So these are orders that they placed months ago. But now the tariffs have hit and the orders are going to be far more expensive than they were before. And this goes to the whole point. This argument of a forced dichotomy between Wall Street and Main Street is non-existent. What is good for the stock market is good for the economy. What's good for the economy is good for the stock market. If the United States has a poor economy for the next 5 years, the stock market will suffer dramatically. If the United States has a great economy with plentiful jobs, opportunity for growth, pay raises, the stock market will flourish. These things don't trade perfectly in line, but they do follow each other closely. And in most cases, the stock market leads the economy. The reason that stocks have tanked recently is because of increased risk of recession, increased risk of unemployment. The reason that large companies do really well is because they're small companies, small buyers, customers that have cash to buy from them. If all these large companies don't have customers that will buy from them, of course their earnings will go down. So this latest news is another data point in this broader theme, that the economy impacts both the stock market, both wealthy people and poor people at the same time. But in most cases, if things go south, if the stock market craters, if the economy suffers, it will disproportionately affect poor people, small businesses. The large companies like Costco, Walmart, Amazon are far better prepared to navigate these difficult waters than the smaller companies. My hope is over the upcoming months that we see a series of trade deals being made, announced, paraded around the White House, that Trump calls them the best deals he's ever seen. Now, if that happens, we'll have renewed optimism that tariffs will come down. If a few deals are even announced, we'll have a greater certainty that more deals will be announced, that more countries will want to come to the negotiating table. So I'm very hopeful that these tariffs can be lowered in aggregate over time. And I expect to see that in the future. Now, finally, we get to the news. And this is something where I think China is now trying to be creative in the ways that they're trying to punish US companies and US services. In this case, they're trying to hit Hollywood. China is limiting the amount of Hollywood films as the trade war hits services. Authorities have vowed on Thursday to moderately reduce the number of US movies allowed in the world's second largest economy, a step floated earlier this week as a possible retaliatory measure. Quote, the wrong action of the US government to abuse the tariff on China will inevitably further reduce domestic audiences' favorability towards American films. I view this news as very bullish. It shows that China is taking a very slow, kind of cautious approach to their retaliatory measures. They're not even blocking every US film. They're just blocking some of them. So their big retaliatory measure that they're doing with our services is preventing a little bit more of already the huge amount of films they block in China. Now, again, China already blocks almost all of our media. So that's something they're doing currently. We allow them to have TikTok in the US where they have a complete social media service. In their country, we can't run Meta, we can't run Instagram, we can't run Google, we can't have Netflix, we can't have Disney Plus, we can't have any streaming service in China. But their big retaliatory measure is to block even a few more of American media companies. That's not really that big of a threat. So I don't think that this is that much of an escalation at all. If anything, I view it as bullish because it means that China is just trying to come up with something that they can show that really doesn't have a big impact. I believe that China wants to make a deal with the United States without making it look like they're getting bullied into it. They want to accomplish those two things. Deal with the US without being bullied. If they can do that and have a deal that also saves face and makes them look strong, I think they're going to make that deal. So overall, I view this optimistically. That's going to be it for this episode. See you in the next one.